Good morning, ladies and gentlemen. Well, last week the price of equities went absolutely nowhere, and we had a marginal improvement to -4 from -9 or -10, whatever it was. But the most important thing is this. Price has turned up, the moving averages are narrowing, and this is basically saying that we're going to have another few weeks of sideways price action, and then most probably we will break higher. As these moving averages converge, the market is actually, the spreads within the market are turning. We will probably very soon have some positive scores, and this trend can even accelerate and at some stage give us a buy signal. We don't need to anticipate that, but what we do need to do is be mindful of where price is likely to be in the next few weeks before a complete rejection or the break actually does happen. It is interesting to have a look at the deviations and see how quickly they're opening up to the upside. This is now way over 2861. It is 2876 with the 3 standard deviations and actually at 3000. So we have the middle band which is turned as well, giving us support at around the 2650 area. 2677, you will remember, is the level that we had to break, and we broke it with Powell speaking, and we've never looked back. We could never regain, go below that level again. We tried 2680 a couple of times, it got bought like crazy, and up we go. So now we know what the downside level is, and that is going to be extremely important. I would actually argue, and I'll show you later, that this is even the more important level. But most importantly, the upside is opening up. Another thing that I want you to be aware of is that the yield curve is bull steepening for the first time since God was a boy. Now, this is, you'll get these data on Fred, the 30-year Treasury note minus the 2-year note. If we now have a look at what's been happening, you will see that the previous high was here 53, and we closed on Friday at nearly 55. So it's breaking up. The same thing is true if you have a look at the 10-year note. To a lesser extent, the previous high here was 20, and we closed at 21. We do have a high here of 21 as well, but this is the only position that we have in size, and you know, because we've been tweeting it, the only thing that we really think that this is the highest risk reward trade that we can see at the moment, being long of 2-year notes and short of the rest of the curve, especially 10s and 30s. We think that this will definitely go back towards 30, while the 30-year note could actually go higher than 65 quite easily. Now, that is a full risk on type of look. Unfortunately, that is just what it is. Facts are facts. And now I shall go into detail and examine what is going on. So, chart of the week, and then I'll go back to what bonds are doing. This is gold over equities. In fact, it's SPY over gold. The more the price goes up, the more equities are appreciating against gold. Why is it important? It's important because, you know, gold is money, everything else is debt. If real prices are going up against the constant, which is gold, that means that we are in an appreciating asset market. I have been ignoring the warning signs of this chart until last week, when this happened, when we had gold falling and equities not. Now, this chart has been absolutely perfect in determining tops and bottoms. It got hugely unsustainably overbought up here. It's come back down and corrected to the line that's basically held it since 2007, and it's just bounced like crazy. You can see that it's still quite a bit lower than what it was when last equities were here at 28.10. These are these levels. This to me says that either gold has quite a bit more to fall, or equities have quite a bit more to go up. I think we will definitely trade this 24 level within, I don't know, a couple of weeks, maybe a month. That is a 10% move, okay, from 22.5 to 24, best part of 10%. So either gold is going to fall quite a bit, or equities are going to go up quite a bit, or a combination of the two. I would have thought that equities easily can go up a couple of percent while gold comes down 5%, and that's how you get there. But we're definitely going there. We are, you know, the bounce has been so strong that 24 is the level that I'm looking for in this spread. Why is that chart of equities over gold important? Is because the yield curve is bull steepening, as I showed you. This is a chart of 5-year yields. It is still within the range that we've been saying is going to stay within. Now I'm definitely looking for this 267, 268 level to be touched over the course of the next couple of weeks. What we do there is going to be absolutely key for the rest of the year, and probably for the next 2 years, because it could be argued that this is just going to be a quick ABC and then we collapse again, or it could be argued that we are actually going to be breaking the 200-day moving average, sloping down, and we're going to go higher than 310. Higher than 310 is, you know, inflation. It's the reflation trade. We're going to go back to it. Now, I don't know if that's going to happen. All I'm saying is that we are bull steepening. Bull steepening means that the market is telling the Fed that is going to remain behind the curve. This is TLT. TLT is now breaking down some very important levels, including the 200-day moving average, which is flattish. We could easily come back and fill this gap down here around the 116 area. That is probably more likely than not to happen. 116, 117 will trade over the course of the next couple of weeks, and then we see, because if we start breaking below that, all hell's gonna break loose in bond markets. The other bond market, which right on clue broke to the upside, is the bunds. And what are we looking for in the bunds now? We're looking for around the 28 level. 25 to 28 yield is going to be where it stops, and then we probably do an inverse head and shoulders type thing before going up again. All the doom and gloom of all the naysayers around the 8 basis points to 15 basis points range have been proven incorrect. Now the 15 basis points is going to be huge support, and I am definitely going to do a lot of stuff again when we get to 15. I've been lucky enough to be short of bond futures, but any kind of retest of this 15 level, I'm going to go absolutely berserk, because I think we're going to go into the 50s eventually. While this yield level of minus 258, 259 holds in the difference between 10-year notes and bonds, the dollar is pretty much range bound. When it breaks to the downside, if it breaks to the downside, we can see dollar appreciation. If it breaks again this kind of 248 level, we will see dollar depreciation. There is absolutely no need in trying to anticipate it. let's see what happens and let's jump on the back of it. I really don't understand people who've got to get in before the move starts. It's perfectly good enough to get the meat of the move. The risk reward is so much better then. At the moment, the dollar is a do nothing. And here is DXY, and I know that Trump's just said that he'd like a weaker dollar. Well, we all know that. I mean, that's not news. Why would you sell it now? Personally, I'm bearish, but so what? I'm looking for reasons to sell it, but the reason is the price. The price is a close below 95.07 on the weekly basis. 95.07 is now so important, it's not true. It's gonna be below the 200-day moving average. It's probably going to be below, by the time it's meandered about, it's going to be probably below this bear flag. And then 95.07, we have the next level, 93.63, goes through there, all hell's going to break loose. This will not hold it. Okay, so the mid 85s won't hold it. It's going to go to 70, 60, 50. It's going to be a bloodbath. Now, do I know what's going to cause it? Absolutely no idea. But with Trump about, it's easy to think of something really stupid that he could do. So why anticipate it? Absolutely no reason. Wait for it. Another thing which is very concerning is that the ultimate risk-off tool, which is the yen, is just keeps on tracking higher with equities, doesn't it? Now, we have this bunch of moving averages here. Let me enlarge it for you. You can see that, all these moving averages, with the most important one, the 200, just above it. Well, it closes above there. We have air. We are going to go to 116, 118. It doesn't square with my view of the dollar, but I don't have a view until we break 95.07. I can be as bearish as I like, but until price confirms my macro thesis, I'm not going to get in. So this is very concerning if you are a risk-off person. Very concerning indeed. I want to, before we go on to equities, actually have a look at the VIX, because this has been the canary in the coal mine all the time. You can see red closes, red closes, red closes on a weekly basis. This is a weekly chart. You can see where the support is. It's around, I don't know, 11.5, 11.50, and then down. Well, nothing until single figures, until in the nines, basically. So 11 to 9 is your big support that we're not going to break through. But the upside seems to be so capped, doesn't it? 16, 16, 10, we just can't make any headway. And we keep on, bouncing and closing below it. 16, 16, 10, which is, 1608 is my swing level. That's been here for years, and we just can't break through it, which basically means the market has no downside impetus. Any market which doesn't have downside impetus in equities eventually breaks higher. End of story. Right, so what did SPX do last week? Absolutely nothing. Basically it closed where it opened. We've got our first non-green bar on the SPX, simply because, of the timing when it closed. Otherwise it'd be green by a couple of points, but so what? This look is not bearish to me. So where is the big support? Here it is, 27.08 to 27.30, and what does that coincide with? It coincides with that whole series of lows that we had after Powell spoke, and we could never break below 26.77. To me, that is going to be the absolute low you're going to get, and you know what my level is. My level up here is 28.61, 28.61, 28.62, where we had such difficulty in breaking through, and eventually when we broke down on this day, that was when the move accelerated, when we broke through 28.61, 28.62. That is where eventually we are going. We might not go there next week. In fact, it's going to be very difficult to go there next week. But over the course of the next 4 to 6 weeks, I definitely see 28.61 trading, and then we shall see what happens, because if it breaks through 28.61, we're going to go way through 3,000. If we now actually look at a monthly chart, you'll see where the monthly swing level is, and it's all right here. It's all between 26.90 and 27.35. So we have a confirmation of the weekly and the monthly. The dailies are the same, I assure you. There's not a lot to see there. That is going to be the absolute bottom that we are looking for over the course of March, and 28.61 is the level on the upside that I see trading, and it's going to be very difficult to break it, I think. So 28.61 to the upside, and 27, I would say 25, I would call it. If it gets to 27.25, I'm going to be a big buyer, and at 28.61 I'm going to be a buyer of put spreads, because I think with volatility indicating that the market is in a compression phase, it is unrealistic to expect it to break 28.61 on a monthly basis on the first attempt. The other thing that tells me that it's unrealistic to expect it to break 28.61 on a first attempt is actually transports. If we have a look and enlarge the transport chart, it is quite different from the SPX chart. SPX has been doing basically nothing all week, while this has been coming down, and so that spread is really moving. You can see that it's actually giving a bit of a sell signal. To me, that is a range bound market. It'll stay in this kind of range, say 10,600 down to 10,000, sorry, 10,180. That is going to be my signal to buy 10,180. But this indicates to me that the odds of us breaking 28.61 in SPX on any first attempt are almost zero. Now, the European markets have actually surprised me. Their strength has been impressive. Impressive from the point of view that if there's one continent which everyone agrees with is in recession, then it's Europe. So what are yields going up in Europe, and what is the equity market doing going up too, and actually performing better than SPX? To me, obviously something is not quite right. This is my canary in the coal mine. It's telling me that we're not in this risk-off phase, but that the upside in equities certainly now is limited. We have the weekly Bollinger Band, and it doesn't break it just like that. It always comes back and trades within it. So where is that level? That level is 11,800, which is exactly where I've always said that I wanted to sell the DAX. Well, if I want to sell the DAX at 11,800 and I always wanted to sell it there, then it's unrealistic to expect SPX to break 28.61 on a first attempt. So 11,800 is the level that I'm looking to sell here, for a retest back down here at around 11,500. 300 quick points, I'll take them. So that is basically it. With volatility converging, I think we have our trades, we have our ideas of what we want to do next week. Before we go to the buyer sheet for next week, I would encourage anyone who didn't watch this video that I published on the 19th of November to look at it, because what I'm saying now is that facts on the ground are beginning to change. This was we are traders here. We're in this to make a quick buck and position ourselves with the best risk-reward ratio that we can look at. So if This was the position on the 19th of November, and we had the worst possible risk reward in being long equities, which turned out to be right. Now these facts are beginning to change. Have a look at what these facts were and have a look at what the facts are now, and change your mind with the facts. Right, so what are our biases? Well, the yield curve is steepening. To me, this is the best trade you can have on in terms of risk reward. Long of twos, short of just about everything else. I think it's going to go quite a bit further than it is. In the 5 years, we're still looking for this 267 level, and TLT, we're still looking for below 117. That is going to be the most important level of the year. When that is reached, all bets are off. I want to see the Bund around the 25 level. If it comes down to 15, I want to buy a whole load of put spreads in futures, because I think the 15 level is great risk reward, amazing risk reward for put spreads. Remember that level. XPX, I would, I know for the whole month they said 27.35, 27.25 is going to be the low, but at the moment, for the next week or so, 27.75 is the level. Up to 28.61. 28.61 I think will fail on the first attempt. It'll fail probably for 2 to 3%. So I expect to see 2800 again after 28.61 trades. I still don't like NQ. It still doesn't have leadership. I don't see the point of playing NQ when the return profile is the same in XPX, while the volatility profile is so much higher in NQ. Don't forget that we are looking for risk reward, and the risk reward in trading NQ as opposed to SPX is not there. Volatility 1175 on deck, I would say, which encourages my view that 2861 will be seen at some stage. European equities, I told you, canary in the coal mine a bit. 11,800 is where you want to do DAX put spreads for a move back down to 11,500. And the dollar is very important. We all know that 95.07 is the level on the downside. If 95.07 gives way, 93.63 will almost certainly trade. And if 93.63 goes, we are talking about double-digit percentage points. With DAX, with Trump around, who knows what the idiot's going to do. That is it for this week. Thank you very much indeed, and tweet you on Monday.